Money Matters, Episode 5, Economics and Investment Analysis. Welcome back to Money Matters. This is Episode 5, covering Chapter 5 of the International Certificate in Wealth and Investment Management, Economics and Investment Analysis. This is the most wide-ranging chapter in the entire book. It accounts for roughly 14 of the 100 exam questions and covers 8 distinct subject areas, from macroeconomics and central banks through to microeconomics, statistics, financial mathematics, and company analysis techniques. Think of it as the intellectual backbone of investment management. We'll move through 8 sections today: macroeconomic theory, including GDP, the economic cycle, balance of payments, inflation and unemployment, fiscal policy, monetary policy, and central banks. Microeconomics, including supply, demand, and the theory of the firm. Statistics, financial mathematics, fundamental and technical analysis, financial ratios, and finally, company valuation models. This is a meaty episode, so let's get into it.
Section 1. Macroeconomic Theory. Economics is the study of how individuals, firms, and countries make decisions under the constraint of scarce resources. Scarcity is fundamental. Land, labor, and capital are limited, and every choice to use them one way means giving up another use. The discipline is often divided into 2 branches: microeconomics, which studies individual markets and firm behavior, and macroeconomics, which takes the big picture view, looking at national income, employment, inflation, and economic growth. Adam Smith, widely regarded as the father of economics, categorized resources into land, labor, and capital. Modern economic theory adds a 4th: enterprise or entrepreneurship, the organizing force that combines the other 3 into productive, wealth-creating activity. At the heart of macroeconomics is the circular flow of income. In its simplest form, households supply the factors of production, labor, land, capital, to firms. Firms use those factors to produce goods and services, which they sell back to households. Money flows in both directions. Firms pay wages, rents, and profits to households, and households spend their income on firms' output. As economies develop, this simple model becomes more complex. Households save some income. Governments tax and spend. Countries trade internationally. These generate leakages from the circular flow: savings, taxation, and imports, and injections into it, investment, government spending, and exports.
National income is measured by gross domestic product, or GDP. GDP measures the total market value of all final goods and services produced within a country's borders during a calendar year. It can be calculated 3 ways. All should give the same answer: by income, by expenditure, or by output. The most common method is the expenditure formula. GDP equals consumption plus investment plus government spending plus exports minus imports. Each component matters. Consumption is household spending on goods and services. Investment is business capital expenditure. Government spending covers public services and infrastructure. Exports are goods produced domestically and sold abroad. Imports are subtracted because they represent spending that flows out of the domestic economy.
GDP is a lagging indicator. It takes time to collect and is frequently revised. It's reported both quarter-on-quarter and year-on-year, with the year-on-year trend being most useful for assessing the economy's health. Real GDP adjusts nominal GDP for inflation using the GDP deflator, allowing comparisons across time. GDP per capita, GDP divided by the population, is used as a rough measure of living standards. But GDP has well-known shortcomings. It ignores inequality in the distribution of wealth, it misses non-marketed activities like unpaid care work and DIY, it ignores pollution and other negative externalities, and it doesn't capture activity in the shadow economy. Gross national product, or GNP, extends GDP by adding the income earned by a country's nationals overseas and subtracting the income earned by foreign nationals within the country. For most large economies, GDP and GNP are similar. But for a country with many workers or companies operating abroad, the gap can be significant.
Now, the economic cycle, also called the business cycle. Economies don't grow in a straight line. Over the short term, actual growth fluctuates around the long-run trend rate of growth. The trend rate depends on labour force growth and productivity, the rate of capital investment in new technology, and the quality of infrastructure. When an economy grows faster than its trend rate, output exceeding potential, inflationary pressures tend to build. When output falls below trend for 2 consecutive quarters, the economy enters recession. The cycle typically moves through recognizable phases: recovery, acceleration, boom, deceleration, and recession.
For investors, the economic cycle matters enormously. Where in the cycle the economy sits influences which sectors perform best. Rising interest rates benefit financial companies but hurt rate-sensitive sectors like real estate. Consumer spending drives retail and leisure during booms. Commodities often peak during late cycle expansions. Defensive sectors, healthcare, utilities, consumer staples, tend to hold up better during downturns. Markets are forward-looking. They often start recovering before the economy officially exits recession, and they often peak before the economy starts turning down.
Next, the balance of payments and international trade. The balance of payments is a summary of all economic transactions between a country and the rest of the world over a year. It has 2 main components. The current account measures the short-term flows of goods and services. The visible trade balance captures physical goods, manufactured products, raw materials. The invisible trade balance covers services, banking, tourism, financial services. Dividends from overseas assets and remittances from nationals working abroad are also included. A current account deficit means a country is importing more than it exports. A surplus means the reverse. The capital account, also called the financial account, records investment flows, foreign direct investment, portfolio investment in stocks and bonds, and transactions in currencies and bank deposits. For the balance of payments to balance, a current account deficit must be funded by a capital account surplus, and vice versa.
Exchange rates are central to all this. An exchange rate is simply the price of one currency in terms of another, determined by supply and demand. If a country's inflation is lower than its peers, its exports become more competitive, demand for its currency rises, and the currency appreciates. Higher interest rates attract foreign capital inflows, pushing the currency up. Speculation can also move exchange rates significantly. Purchasing power parity is a theory stating that exchange rates should reflect price differences between countries. A basket of goods should cost the same everywhere once exchange rates are applied. In practice, exchange rates deviate from PPP in the short run, but tend to gravitate towards it over time.
Under a fixed exchange rate system, a country pegs its currency to another, typically the US dollar, and must actively intervene in markets to maintain that peg. Under a floating system, the currency finds its own level through market forces, though many central banks intervene periodically to influence the rate. If a currency depreciates, exports become cheaper and more competitive, imports become more expensive, and the trade balance tends to improve over time. But the effect isn't immediate. Import prices rise immediately, worsening the trade balance before it improves. This pattern is known as the J-curve effect. Plotted on a graph over time, the trade balance dips before recovering, tracing the shape of the letter J.
International trade benefits countries through specialization, economies of scale and the division of labor, and through competition, which drives quality improvement and productivity gains. The law of comparative advantage, holds that even if one country can produce everything more efficiently than another, both still benefit from trading if each focuses on what it does relatively best. Trade protectionism, tariffs, quotas, and subsidies can protect specific domestic industries in the short run, but typically leads to trade retaliation and higher prices for consumers overall. The World Trade Organization exists to reduce barriers to free trade.
Now, let's talk about inflation and unemployment, two of the most politically and economically significant variables in macroeconomics. Inflation is the rate at which prices in general are rising, eroding the purchasing power of money. Most countries measure it using a consumer price index, the CPI, which tracks the prices of a basket of goods and services representative of typical household spending. Some countries, like the UK, also use the Retail Price Index. The Producer Price Index, PPI, measures price changes at the factory gate, making it a useful leading indicator of consumer inflation to come. There are two main types of inflation. Cost-push inflation occurs when rising production costs, energy, raw materials, wages, are passed on to consumers. The 2022 surge in inflation across developed economies was a textbook example. Russia's invasion of Ukraine drove up energy prices, global supply chains were still recovering from COVID disruptions, and higher costs fed through to consumer prices across virtually every sector.
Demand pull inflation happens when the economy is running above its full capacity. Too much money chasing too few goods. In 2021 and 2022, pent-up consumer demand after the COVID lockdowns, combined with government stimulus payments and ultra-low interest rates, generated a classic demand pull surge. Deflation, a general fall in prices, sounds appealing, but is actually dangerous. It discourages spending as consumers delay purchases waiting for lower prices, creates a deflationary spiral of reduced demand and production, and increases the real burden of debt. Japan experienced persistent deflation from the 1990s onwards.
Disinflation is simply a slowing rate of inflation, not deflation, but a reduction in the pace of price increases. Stagflation is the worst of both worlds. High inflation combined with slow or negative economic growth, as occurred in the 1970s, when oil price shocks hit developed economies simultaneously.
Real returns matter enormously in investment. The nominal rate of return is simply the stated percentage gain. The real rate is the nominal rate minus inflation. If your savings account pays 2%, but inflation is running at 4%, your real return is negative 2%. You're actually losing purchasing power. Advisors must always frame client investment goals in real, not just nominal terms.
Unemployment comes in several varieties. Cyclical unemployment rises during recessions as demand for labor falls with output. Structural unemployment arises when changes in the economy, technological change, shifting industrial structures, render certain skills obsolete. Frictional unemployment is the short-term unemployment that occurs as workers move between jobs. Classical unemployment happens when wages are set too high, pricing some workers out of the market. Seasonal unemployment affects industries with seasonal demand patterns.
Every economy has a natural rate of unemployment, the rate that exists even when the economy is operating at full capacity. This reflects structural, frictional, classical, and seasonal unemployment. Cyclical unemployment, by contrast, is the additional unemployment that arises in downturns.
Section 6 and 7, Fiscal and Monetary Policy. These are the two main levers governments use to manage their economies. Fiscal policy refers to government decisions on taxation and spending. It was popularized by John Maynard Keynes as a tool to combat the mass unemployment of the 1930s Great Depression. An expansionary fiscal policy boosts aggregate demand by increasing government spending or cutting taxes, financed by borrowing, widening the budget deficit. A contractionary fiscal policy does the reverse, cutting spending or raising taxes to cool an overheating economy. Automatic stabilizers are a passive form of fiscal policy, things like unemployment benefits and progressive taxation that automatically increase government spending and reduce tax revenues during downturns, cushioning the economy without any deliberate policy action.
The practical challenges of fiscal policy are significant. Time lags mean that by the time policy is implemented and takes effect, the economic situation may have changed. Crowding out is a risk with expansionary policy. Government borrowing raises interest rates, potentially displacing private sector investment. And fiscal expansions are politically difficult to reverse. Once spending programs are legislated, cutting them is unpopular, risking persistent deficits and eventual inflationary pressure. Modern monetary theory, MMT, challenges some of these traditional constraints. MMT argues that governments issuing their own currency can never be forced to default on debts in that currency, since they can always create more money. It suggests that fiscal expansion to meet economic goals, including full employment, should be the primary policy tool, with inflation being managed through taxation. MMT gained attention as countries ran unprecedented deficits in response to COVID. Critics warn that it risks out-of-control inflation if spending isn't carefully calibrated.
Monetary policy refers to central bank actions to manage the money supply and interest rates. Its primary goal is to balance growth and inflation, stimulating the economy when it's weak, restraining it when inflation threatens. The money supply has different layers. Narrow money, called M0 or M1 depending on the country, includes the most liquid forms, physical cash and overnight deposits. Broad money, M2, M3 or M4, includes narrow money plus a wider range of bank deposits and short-term instruments. In the US, M1 and M2 are the primary measures. In the UK, M0 and M4.
Banks only hold a fraction of their deposits in reserve. The rest is lent out. This fractional reserve banking means that bank lending creates new money through a multiplier effect. When a bank makes a loan, the borrower deposits the proceeds, which the bank can lend out again. The total increase in the money supply can be many times the original injection. Central banks influence the money supply through three main tools. First, interest rate setting. Raising rates makes borrowing more expensive, reducing money demand. Cutting rates does the reverse. Second, open market operations, buying or selling government securities in the market. When a central bank buys bonds, it pays with newly created money, expanding the supply. Selling bonds removes money from circulation. Third, reserve requirements. The minimum reserves commercial banks must hold. Increasing reserve requirements reduces lending capacity.
Quantitative easing, QE, is an unconventional tool deployed when interest rates are already near zero and conventional policy has run out of room. Under QE, the central bank directly purchases assets, typically government bonds, but sometimes mortgage-backed securities or corporate bonds, from financial institutions. This injects money directly into the financial system, pushing down long-term yields, boosting asset prices, and encouraging spending and investment. The US Federal Reserve, the Bank of England, the European Central Bank, and the Bank of Japan all deployed QE aggressively after the 2008 financial crisis and again during COVID.
Quantitative tightening, QT, is the opposite, allowing QE assets to mature without reinvestment or actively selling them back into the market. QT contracts the money supply, puts upward pressure on yields and interest rates, and is used to combat inflation after a period of excessive stimulus.
Section 8. Central banks. Central banks are the institutions responsible for managing a country's money supply, interest rates, and financial stability. They serve several critical functions, acting as banker to the commercial banking system, managing the national debt, regulating banks, acting as lender of last resort during financial crises, setting short-term interest rates, issuing currency, and holding foreign exchange reserves to defend the currency. Their independence from political interference is considered vital to credibility. A central bank that can be instructed to print money on demand would rapidly lose the trust of financial markets. Most major central banks operate independently, though their governors are typically appointed by governments.
The U.S. Federal Reserve, the Fed, was established in 1913 and comprises 12 regional reserve banks. Monetary policy is set by the Federal Open Market Committee, the FOMC, which meets 8 times a year to assess economic conditions and set the federal funds rate. The Fed has a dual mandate: maximum employment and price stability, with a 2% average inflation target. The European Central Bank, the ECB, sets monetary policy for the Eurozone, the 19 EU member states that share the euro. It has a singular mandate: price stability, targeting inflation at 2% as measured by the Harmonized Index of Consumer Prices. The ECB is based in Frankfurt, and its governing council includes the governors of all Eurozone national central banks. Notably, the ECB responded to COVID differently from many peers. Rather than cutting rates further from already historically low levels, it focused on expanding asset purchases and supporting bank lending.
The Bank of England was founded in 1694 and gained full operational independence in 1997, when the Monetary Policy Committee was established to set interest rates free from political interference. The MPC meets monthly and targets 2% CPI inflation. The Bank of England also has a financial stability mandate, monitoring systemic risks to the financial system.
The Bank of Japan has long grappled with deflation and slow growth, maintaining ultra-low and even negative interest rates for extended periods. The People's Bank of China, the PBC, manages monetary policy and maintains exchange rate stability for the world's second-largest economy. And the Bank of Canada, established in 1934, promotes Canada's economic and financial welfare with considerable operational independence.
Now let's move into Section 3, Microeconomic Theory. Microeconomics focuses on how individual consumers and firms make decisions in specific markets. The central concept is the interaction of supply and demand, which determines the price and quantity of goods and services in a free market. The demand curve shows the quantity of a good consumers will buy at different prices. It slopes downward. When prices rise, demand falls, and vice versa. This negative relationship between price and quantity demanded is the law of demand. But the demand curve can also shift, moving entirely left or right, if something other than price changes. Shifts to the right represent increased demand at every price level. Shifts to the left represent decreased demand. Common causes include changes in consumer income, changes in the prices of substitute or complementary goods, and changes in consumer tastes.
The supply curve shows how much producers will supply at different price levels. It slopes upward. Higher prices make production more profitable, so more is supplied. Supply curves shift when production costs change. Rising resource prices shift the curve left, reducing supply. New technology or improved efficiency shifts it right, increasing supply. The equilibrium price is where supply and demand curves intersect. The price at which the quantity supplied exactly equals the quantity demanded. This is the market clearing price. If the market price is above equilibrium, excess supply builds up, pushing prices down. If below, excess demand drives prices up. Free markets have a natural tendency to return to equilibrium, a concept known as Say's law.
Now, elasticity, one of the most practically useful concepts in microeconomics. Price elasticity of demand, or PED, measures how much the quantity demanded changes in response to a price change. It's calculated as the percentage change in quantity demanded divided by the percentage change in price. If a 5% price cut leads to a 20% increase in sales, the PED is -4, meaning demand is highly elastic very responsive to price. Luxury goods tend to be elastic, necessities tend to be inelastic. Goods with easily available substitutes are more elastic. Addictive goods with no substitutes, like tobacco, are highly inelastic.
Understanding PED helps firms set prices strategically. Rail companies charge higher prices for peak time travel, where demand is inelastic, and lower prices off-peak, where it's elastic. Total revenue is maximized at the point of unit elasticity, where demand and price changes are proportional. Cross-elasticity of demand measures how the demand for one good responds to a change in the price of another. Substitutes have positive cross-elasticity. If the price of beef rises, demand for chicken rises. Complementary goods have negative cross-elasticity. If petrol prices rise, demand for cars tends to fall. Income elasticity of demand measures how demand responds to changes in income. Normal goods, things we buy more of as income rises, have positive income elasticity. Luxury goods have income elasticity greater than 1. Demand grows faster than income. Inferior goods, things we switch away from as income rises, like basic generic brands, have negative income elasticity.
The theory of the firm starts with a simplifying assumption. Firms seek to maximize profits. They do this by producing output up to the point where marginal revenue equals marginal cost. The additional revenue from one more unit equals the additional cost of producing it. Beyond that point, each additional unit costs more to produce than it earns in revenue, so it reduces profit. In the short run, some inputs are fixed, particularly capital equipment. Adding more labor to a fixed amount of capital initially increases productivity, increasing returns. But eventually, diminishing returns set in. As more workers share the same equipment, each additional worker adds less and less to output. Average and marginal costs eventually rise. In the long run, all inputs can be varied. Firms benefit from economies of scale as they grow, spreading fixed costs, specializing labor, and using larger, more efficient equipment. Production costs are minimized at the minimum efficient scale. Beyond that, dice economies of scale set in as management complexity grows, coordination becomes harder, and bureaucracy increases.
Market structures range from perfect competition at one extreme to monopoly at the other. In perfect competition, an infinite number of identical firms sell identical products at a price set by the market. No firm has pricing power. In the long run, only normal profits are possible, because any supernormal profits attract new entrants, expanding supply until excess profits are competed away. Grain markets come close to this model. A monopoly has a single producer who can set its own price. Oligopolies, industries dominated by a small number of large firms, exhibit strategic interdependence, often using advertising and product differentiation rather than price competition to protect market share. Governments generally disfavor monopolies and oligopolies because they reduce consumer choice and may lead to higher prices and less innovation.
Section 4. Statistics. Investment management involves handling large amounts of quantitative data. Statistics provide the tools to make sense of it. Measures of central tendency summarize a dataset with a single representative value. The arithmetic mean is the average. Sum all values, divide by the count. It's the most widely used measure but is sensitive to extreme outliers. The median is the middle value when data is sorted, useful when the distribution is skewed or contains outliers, since it's unaffected by extreme values. The mode is the most frequently occurring value, useful for categorical data.
The geometric mean is particularly important in investment. Rather than adding values, it multiplies them and takes the nth root. It properly accounts for compounding, making it the correct measure of average returns over time. If a fund returns 5%, 6%, and 5.5% in 3 successive years, the geometric mean gives the true compound annual average, which will always be slightly lower than the arithmetic mean. Measures of dispersion quantify how spread out data is around its average. The range is simply the difference between the highest and lowest values, quick to calculate but heavily influenced by outliers. Variance measures the average squared deviation from the mean. It amplifies large deviations. Standard deviation is the square root of variance, expressed in the same units as the original data, and is the most widely used measure of investment risk. In a normal distribution, about 68% of observations fall within one standard deviation of the mean, 95% within two, and 99.7% within three.
The interquartile range ranks observations and measures the spread between the 25th and 75th percentile. It's particularly useful for comparing fund performance, placing managers in performance quartiles. Correlation measures how two variables move together, scaled from +1, perfect positive correlation, to -1, perfect negative correlation. Zero correlation means no relationship. Diversification works by combining assets with low or negative correlation. When one falls, the other doesn't necessarily fall too. But correlations are not stable. During market stress, as seen in the 2008 financial crisis and COVID, correlations across asset classes tend to spike upward, reducing the diversification benefit precisely when you need it most.
Covariance is a related concept measuring the joint variability of two assets. It equals the correlation coefficient multiplied by the standard deviations of both assets. For portfolio construction, you want assets with low covariance, low standard deviations, and low correlation.
Section 5, Financial Mathematics. Money has a time value. $100 today is worth more than $100 in 5 years, because today's money can be invested to earn a return. Simple interest is calculated only on the original principal. If you invest 1,000 yuan at 5% for 1 year, you earn 50 yuan. Straightforward. Compound interest calculates interest on the accumulating balance, interest on interest. This is where the magic of long-term investing comes from. £100 invested at 5% per year for 5 years becomes £127 and 63 pence through compounding. The formula is final amount equals principal multiplied by 1 plus the rate, raised to the power of the number of periods.
Future value tells you what a sum invested today will be worth at a future date. The formula is FV equals PV multiplied by 1 plus R, all raised to the power of N. If a client invests $10,000 at 6% per year for 7 years, the future value is approximately $15,036. Present value is the reverse. It asks how much a future sum is worth in today's money. Divide the future value by 1 plus the rate raised to the power of N. This is called discounting. The rule of 72 is a useful mental shortcut. Divide 72 by the annual growth rate, and the result is approximately how many years it takes for an investment to double. The present value of an annuity, a series of equal regular payments, can be calculated by discounting each payment individually and summing them, or using the annuity formula. A perpetuity is an infinite stream of equal payments. Its present value is simply the annual payment divided by the discount rate. If a commercial property generates £10,000 per year and the discount rate is 8%, the present value is £125,000.
Section 6, Fundamental and Technical Analysis. There are two main schools of thought for analyzing securities. Fundamental analysis asks, what is this company actually worth? Technical analysis asks, what does the price chart tell us about where the price is going? Fundamental analysis involves a deep examination of a company's financial statements, competitive position, management quality, and industry dynamics. The goal is to identify the intrinsic value of a security, what it's truly worth based on its future cash flows, and compare that to the current market price. If the market price is below intrinsic value, it's a buy opportunity. Above it, a sell.
Fundamental analysts examine both quantitative data, financial ratios, earnings growth, cash generation, and qualitative factors, the strength of the brand, the quality of management, the competitive moat, corporate governance standards.
Technical analysis takes a completely different approach. It doesn't care about intrinsic value. It believes that all available information is already reflected in the price, and that price movements follow patterns that repeat over time. By studying historical price charts and volume data, technical analysts try to identify trends, support and resistance levels, and reversal signals. Key concepts in technical analysis include trend. Prices move in identifiable uptrends, downtrends, or sideways ranges. Primary movements are long-term trends lasting years, what we call bull and bear markets. Secondary movements last weeks to months. Tertiary movements are short-term, day-to-day fluctuations.
Specific chart patterns matter too. The head and shoulders pattern, a peak, a higher peak, then a lower peak, signals a likely trend reversal from an uptrend to a downtrend. Triangle patterns suggest consolidation before a breakout. When price breaks out of a defined range with high volume, the move is expected to continue.
Volume, momentum, and moving averages are technical indicators. Volume confirms the strength of a price move. A breakout on high volume is more reliable than one on low volume. Momentum indicators track the rate of price change. Moving averages smooth out short-term noise to reveal the underlying trend.
Fundamental and technical analysis are not mutually exclusive. Many practitioners use both. A fund manager might use fundamental analysis to identify which securities to buy based on long-term value, and technical analysis to decide the best timing for entering and exiting positions.
Sections 7 and 8, Financial Ratios and Valuation. Financial ratios transform raw accounting data into comparable, actionable metrics. Let's run through the key categories. Profitability ratios assess how efficiently management uses assets to generate profit. Return on capital employed, ROCE, divides profit before interest and tax by total capital employed, expressing the return as a percentage. It's broken down further into profit margin, profit as a percentage of sales, and asset turnover, sales relative to capital employed. Gross profit margin measures what's left after direct production costs. Operating profit margin captures efficiency after overhead costs. Net profit margin, after interest and tax, is the most comprehensive profitability measure.
Gearing ratios measure financial risk. Financial gearing, the debt-to-equity ratio, compares interest-bearing debt to shareholders' equity. High gearing amplifies both gains and losses. Interest cover measures how many times a company's operating profit covers its interest payments. A ratio of 1.5 or below raises alarm bells about the company's ability to service its debt. Liquidity ratios assess whether a company can meet short-term obligations. The current ratio divides current assets by current liabilities. A ratio above 1 is healthy, ideally between 1.2 and 2. The quick ratio, or acid test, excludes stock from current assets for a tighter measure. The cash ratio is the most conservative, just cash and cash equivalents divided by current liabilities.
Z-score analysis is a statistical tool for assessing bankruptcy risk, combining multiple financial ratios into a single score. A Z-score below 1.8 signals financial distress and high bankruptcy probability. Above 3 suggests solid financial health. Between 1.8 and 3 is a grey zone, requiring further investigation.
Investment valuation ratios focus on what investors should pay for a company's shares. Earnings per share, EPS, measures the after-tax profit per share available to ordinary shareholders. It's one of the most closely watched metrics in equity analysis. EBIT, earnings before interest and tax, strips out financial structure effects to compare operational profitability across companies. EBITDA, earnings before interest, taxes, depreciation and amortization, goes further, adding back non-cash charges, making it easier to compare companies across different industries and accounting conventions. But EBITDA has limitations. It can be manipulated and ignores real capital requirements.
The price-to-earnings ratio, the PE, divides the share price by EPS. A high PE reflects investor expectations of strong future earnings growth. A low PE suggests below-average growth expectations or undervaluation. The PEG ratio, PE divided by the expected earnings growth rate, helps assess whether a PE is justified relative to growth prospects. A PEG below 1 may indicate attractive value. Historical PE is based on past earnings. Prospective PE is based on earnings forecasts.
Dividend yield divides the net dividend per share by the share price, allowing income comparisons across shares and other asset classes. Dividend cover is EPS divided by the dividend per share. A ratio above 2 is generally considered sustainable. Below 1.5 raises questions. Below 1 means the company is paying dividends from reserves. The price-to-book ratio, P over B, compares the share price to the net asset value per share. A ratio of 1 means the market values the company at exactly its book value. Below 1 may signal undervaluation. Above 1 reflects goodwill, brand value, or growth expectations above what the balance sheet shows.
Finally, company valuation models. The Gordon Growth Model is a fundamental approach to valuing equities. It prices a share as the present value of all future dividends, assuming those dividends grow at a constant rate forever. The formula is share price equals the expected dividend divided by the required rate of return minus the dividend growth rate.
For example, if a company will pay a dividend of 10 pence next year, the required return is 11%, and dividends are expected to grow at 5% per year. The fair value of the share is 10 pence divided by 6%, which equals approximately £1.67. Without the growth element, the same company would be worth just 91 pence. Growth assumptions make a huge difference to valuations.
Economic value added, EVA, is a shareholder value concept that measures whether a company earns more than its cost of capital. EVA equals net operating profit after taxes, minus the product of invested capital and the weighted average cost of capital. A positive EVA means the company is creating value, generating returns above its funding costs. A negative EVA means value is being destroyed.
Market value added, MVA, extends this by comparing the market's total valuation of the company to the total capital invested in it. If the market value exceeds the capital invested, the company has added value for its shareholders. MVA effectively represents the present value of all expected future EVAs.
Let's recap this enormous chapter. Chapter 5 is the analytical backbone of wealth management. It provides the framework for understanding the world that investments operate in and the tools for analyzing them. Macroeconomics gives us GDP, the key measure of economic output, and the economic cycle, which drives the relative performance of different asset classes. The balance of payments connects trade, exchange rates, and capital flows. Inflation erodes purchasing power and is the primary target of central bank policy. Fiscal policy, taxation and government spending, and monetary policy, interest rates and money supply management are the two main tools governments and central banks use to stabilize economies. QE and QT are unconventional extensions of monetary policy for extreme conditions. Central banks, the Fed, ECB, Bank of England, Bank of Japan, and People's Bank of China, are the institutions implementing these policies, with independence from political interference being essential to their credibility.
Microeconomics covers supply and demand curves, price determination, elasticity, the theory of the firm, and market structures from perfect competition to monopoly.
Statistics give us the arithmetic and geometric mean, median, mode, standard deviation, variance, and correlation. tools for measuring central tendency, dispersion, and the relationships between assets that underpin portfolio construction.
Financial mathematics covers simple and compound interest, future value, present value, annuities, and perpetuities, the building blocks for discounting cash flows and comparing investment outcomes.
Fundamental analysis values companies based on their intrinsic worth, using financial statements and qualitative assessment. Technical analysis uses price charts, trends, volume, and momentum to identify trading signals. Both have a role in the investment process.
Financial ratios, ROCE, profit margins, gearing, interest cover, current ratio, EPS, PE, dividend yield, PB. Translate accounting data into comparable, investable insights. Z-score analysis assesses bankruptcy risk. The Gordon Growth Model, EVA, and MVA provide frameworks for equity valuation that go beyond simple ratio analysis.
That wraps up episode 5 of Money Matters, the most demanding episode yet in terms of breadth. Chapter 5 is dense and wide-ranging, but it's also foundational. Every investment decision, whether to buy a bond, allocate to equities, or assess a company's shares, draws on the concepts we've covered today. Next episode, we move to Chapter 6, Investment Management, covering portfolio construction theory, investment strategies, the role of asset classes, risk and return frameworks, and performance measurement. It accounts for 15 of the exam's 100 questions, the single highest weighted chapter in the book. Until then, keep learning, keep thinking, and I'll see you next time.